Hello, I'm Lelda Smeets for the Finance News Network, and joining me from Commsec is economist Savanth Sebastian. Savanth, welcome back to FNN.
Thanks very much.
Australia's unemployment rate has just risen by more than many had been expecting, climbing to a 12-year high of 6.4%. Were you surprised?
It was certainly a big surprise, not just for us, but I think the market. We were expecting unemployment to fall from 6 to 5.9%. The prior month was revised up to 6.1%, and this unemployment rate hitting 6.4%, well, the highest level in 12 years. So certainly concerning from the headline figure. But I think if you delve in a little bit deeper, it's probably not as bad a result as what it's been made out to be. Firstly, the lift in unemployment was largely driven by more people looking for work, discouraged workers coming back into the workforce. In the last couple of months, we've heard of business hiring intentions lifting, job advertisements have picked up substantially, and I think it's a sign that more people are coming and looking for work, which is not a bad outcome provided the jobs turn up over the next few months. The other side of the equation is that we're shifting from part-time to full-time jobs. So you've actually started to see that there's been a substantial shift in full-time employment. And we're at that transition point when it comes to the labour market. If you look at full-time jobs, we've created 110,000 full-time jobs since the start of 2014. It's the best start to a calendar year in 6 years, and I think it just highlights that there's some underlying strength in the labour market.
Okay, so where would you expect the unemployment rate to trend over the coming year?
Look, I think we'll probably see it volatile in the next few months given the transition effects in the labour market. It's probably likely to peak in the next couple of months but then start to ease off, particularly in the second half of 2015. I think there's some serious jobs growth that's going to come. We look at the finance sector, education, healthcare and construction. Those would be probably sectors that drive jobs growth and have been the key areas of jobs growth over the past year. Now, keep in mind that unemployment rate may be a little bit more volatile in the next couple of months, but if you look at key jobs, I think the story here is that the Reserve Bank wouldn't be overly concerned.
And Savanth, what does the latest jobless rate mean for Australia's key cash rate?
Well, I think it's pretty clear it means the Reserve Bank is not going to be raising interest rates this year. Whether it comes down to another rate cut remains to be seen. I don't think the Reserve Bank would be wanting to cut rates unless you saw a huge spike in unemployment from here. Keep in mind that somewhat perversely, maybe the Reserve Bank would be quite encouraged by this latest result because it pushed down the Australian dollar, and that's something that they've wanted to do for a number of months, and they weren't able to push it down, but these numbers certainly did, and it's holding a lot lower than where it was in the last month or so. So I think the Reserve Bank would be more about interest rate stability. They've seen that the federal budget effectively pull back confidence. Now confidence levels have responded quite dramatically. We've got the best confidence since January. Retail sales is once again lifting. The Reserve Bank would be glass half full and quietly optimistic.
So what are you expecting the next interest rate move will be, and when will it happen?
We're expecting it in the first quarter of 2015, and that's largely to be driven by, I guess, improvements in the labour market. I think if you go back 12 months, it was hours work that started to lift, then part-time employment, and now it's full-time. So business profitability has improved, and that means that they're adding that one extra worker. So as we move into early 2015, that labour market story is likely to get stronger. The Reserve Bank will feel comfortable lifting rates at that point.
Right, now onto the markets. August has gotten off to a shaky start for the Australian share market. Could this be the beginning of a correction?
Look, I think it's a modest correction. It comes back to the fact that the global economy, downside risks to global growth have really become to the fore. But the issue lies with those political risks that are now driving markets. And at the same time, you've got the Federal Reserve effectively finishing off and tapering off their stimulus program. So there's no cheap money out there anymore. So those are probably the big drivers. And if you look at share markets across the globe, you'd have to say at best, they're fair value. If not, they're a little bit expensive. So in that environment, I think a modest correction is likely. But given the amount of cash that is on the sidelines with super funds, institutions and retail, it's very unlikely that you're going to see a huge pullback because growth is likely to lift from here. We hear of the Chinese growth story improving. The US growth story, the IMF is expecting 3% growth over 2015. It's best growth if achieved in a decade. So those sort of numbers seem to suggest that the share market's a modest correction, but nothing too dramatic.
So finally, Savanth, where do you see the S&P ASX 200 index moving over the coming financial year?
Well, we expect it to get up to 6,100 in the end of this financial year, so midway through 2015. So if you look at this financial year, we're expecting a gain of something like 13-14%. You add in dividend yield and you're getting a pretty healthy outcome. I think the key in this reporting season that we're just coming into now is whether companies that have been cashed up in the last 12 months by cost-cutting measures start to pay out some of that money in terms of a dividend. And at the moment, we haven't really seen that. The big question is if that takes place, because that's got to be the PE, provide the next level of PE expansion for the market.
Savanth Sebastian, thank you so much for your outlook today.
Thanks very much.